El seminario comenzará en breve. Por favor, permanezca en línea. El seminario comenzará en breve. Por favor, permanezca en línea. El seminario comenzará en breve. Por favor, permanezca en línea. El seminario comenzará en breve. Por favor, permanezca en línea. El seminario comenzará en breve. Por favor, permanezca en línea. La emisión está comenzando. Todos los asistentes están en modo de solo escucha.
Andrew Wilkinson with Interactive Brokers, joining me all the way from sunny Chicago, Matt Cashman. How are you?
I'm doing really well, Andrew. Thanks for having me today. I'm excited to be here and talk about some options.
Very good. And you're going to be talking about, the rule of 16. What's all that about, Matt?
An excellent question. The rule of 16 is a way that option traders have since the dawn of option trading, have been taking annualized implied volatility numbers, which is basically what implied vol is, and breaking it down into some more digestible, easily usable, and relevant pieces of information for things like daily movement that you can expect from the underlying. So it's not a guarantee, but it helps you to build a frame of reference around how much you think something should move.
Excellent. Okay, well, what I'm going to do is put up my disclosures and do my little bit of housekeeping here. Interactive Brokers always ask me to put up various disclosures and disclaimers at the start of all of our webinars so that you, the viewer, can understand the potential risks of some of the products we're going to be talking about in today's event. If you want to do a drive-through, there's a handout section which you can expand on the GoToWebinar software, expand that, download the PDF, and do as you will with it. And you're going to get a recording link in your email a couple of hours after we've wrapped up here today. I'm going to make Matt the presenter now so that he can load in his screen and go through his events, his deck. And let's see, we're going to do a Q&A towards the end of the session. So please do put your questions into the chat panel. So with that, Matt, are you able to take control of the screen?
I am trying right now, Andrew, but it doesn't seem to let me. Let's see, change presenter, make me the presenter. There we are. How about that? Let's see.
Oh.
Wait, we need the other screen. Oh boy, Andrew.
Yep. Oh.
At least that one's not, at least it's still appropriate for what we're doing here. Hold on a second. Oh man. I swear I've done this before, Andrew.
I know you have. There it is. We're seeing it correctly now, Matt. Very good.
Not my first rodeo.
I'm going to go on mute and hand over to you, Matt.
Excellent. Thanks, mate. I appreciate it. All right. Hello, everyone. Thank you for joining us today for, I believe, the fourth IBKR and OIC webinar of 2025. We're calling this one the Rule of 16. Today, I'm going to take you through this back of the envelope calculation that option traders have been using forever to take annualized implied volatility metrics and break it down into something that you can use a little bit more easily. Digestible pieces of information that give you ideas about how much something might be forecasted to move, all from how options are priced, all from the implied volatility of the options. This topic is especially pertinent, I think, right now. We're seeing a lot of market volatility. We've seen it lately, both in the equity side and on the rates side. And I think it's really fundamental to a broad-based understanding of how options are priced and expectations. And while moves like what you're seeing in the market these days can be painful in many ways, looking at the options pricing and seeing how that pricing is moving around and the expectations that like really gives off as far as how the options are priced gives you a deeper level, I think, a deeper level of understanding as to why the options are priced in the way that they are, and maybe why the options are actually moving in the way that they are. So I hope I can impart some of that knowledge to you today through this concept. Let's talk a little bit about my disclaimer, which is always the same thing. In order to simplify calculations, et cetera, any strategy that I discuss, et cetera. Not an endorsement, recommendation, or solicitation to buy or sell securities. A little bit of housekeeping here. These are trademarks that you'll see used throughout, and they are wholly owned by the OCC. And really quickly, a little bit of background about where I work, the OCC and the OIC. The Options Industry Council is the educational arm of our parent company, the OCC, which is the largest clearing corporation of equity and index exchange traded options in the world. OIC started out as a collective in 1992 to better help people understand the risks and benefits of exchange traded options. We continue to pursue that goal mainly through optionseducation.org, which you can see right here. That's our website where we host all of our educational materials. You're going to find online courses, podcasts, videos, webinars, et cetera, so many different ways to learn about options there. And the idea behind it is that if you can think of a way that you can learn about options, hopefully we got you covered with either the courses, the podcasts, the videos, or the webinars that we have there. If you have questions when you're looking at this educational material, we want you to get in touch with us at options@theocc.com. That email address goes to an investor education desk that is staffed by myself and 3 other instructors, all of whom have north of 20 years of experience in the options business, either in trading, market making, brokerage, all kinds of different facets of the options business. We've got you covered there as well. So make sure to send us email questions as they occur to you and check out optionseducation.org. Let's get right started to what we're going to talk about today. I always add options volume at the beginning of these presentations because I think it's really important. We're north of 12 billion contracts of cleared volume last year. It's the first time that's ever happened. As you can see here from bottom left to top right, volume continues to grow in this marketplace, it, to me, makes what I do as an options instructor, as an educator, that much more vital to like what is happening out there. I want to make sure that people understand how these options work when they're in there trading them. And while I understand that most people aren't going to go through the entire process of understanding from top to bottom before they start trading, our goal is to make sure that we're here for you along the way as you are trading and encountering questions. Make sure you send them our way. Let's talk briefly about what we're going to cover today. I'm going to tell you what the rule of 16 is. What is the formula for it? How do you actually use it? We're going to talk about the two parts of it, which are annual variance, and then we're going to break down the annual variance into smaller pieces and talk about how you might be able to use that in real world applications. And I'm going to have something at the end called solve for the standard deviation, which theoretically will allow you to kind of see how we break this down into three separate different ways and give you a little bit of practice as to how you might see this in front of you. So let's talk about what is the rule of 16. It is a way, like I've said, to convert annual implied volatility into daily expectations of underlying movement, into smaller chunks. A lot of people use it to simplify risk calculations or to think about what the market is telling them from option prices as to how much these things might theoretically move around, expectations of movement going forward. You can think of a daily standard dev as how much you might expect this thing to move on any normal trading day based on given implied volatility levels and option prices. Here's the math of how this works. Daily standard dev is equal to implied volatility of the option that you're looking at. Most of the time, we like to use implied volatility of at-the-money options because the actual pricing of how the straddle is priced, that at-the-money call and at-the-money put, helps to give you the most kind of accurate picture of how the market is pricing movement. So we take the implied volatility, oftentimes of the straddle, but not all the time. Implied volatility of the straddle times the stock price, the underlying price. It doesn't have to be a stock. It can be the underlying price. I mean, you could use this in commodities. You could use it in all kinds of different things, in bonds. And then you divide by the square root of trading days. This is how we get to the daily standard deviation. So in this case, when we're talking about the rule of 16, and the reason why we call it the rule of 16 is because, and I'll show you this in just a moment, that's part of how we get to this daily standard dev. But it's not just the daily standard deviation that we can solve for. We can solve for lots of different things, but let's talk about the formula itself. So daily standard deviation is equal to, again, implied vol times stock price in the top, the numerator, divided by the square root of trading days. Now, for simplicity's sake, trading days we use as 252 trading days. There's 252 trading days in a year. You take the square root of that and you get like 15 points, I think it's 184 or 814. We round it to 16. I think it's 15.814. We round it to 16 because we're using this again as a back of the envelope calculation. This is a very simple kind of rudimentary calculation. And that's why people call it the rule of 16, because when people were using this formula back in the day, before we were all sitting behind multiple screen monitor setups of giant computers, people were trying to do this in the pit on the back of what we used to call SPOO cards, which were kind of how you would keep track of your position, which in many ways is mind-blowing to think that that's how we used to do it, but it was. And so this gives you a really quick way to be able to do this by just looking at the implied vol of an option and the stock price. Now, let's talk about the numerator and the denominator separately. The reason why is because I think this gives you a better idea of why this formula works, what it's doing, and gives you a more functional way to kind of think about it to be able to understand what's going on here. The numerator, which is what I just told you, is what I refer to as the big block of variance. Up top, we have implied volatility times stock price. That's our numerator. I want you to think about the numerator as the big block of variance. The reason why is because implied volatility, like I said before, is an annual metric. And so if you take implied volatility and you multiply it by the stock price, what you're actually getting is the amount of theoretical movement or expected movement for the entire year. We call that, generally speaking, annualized variance, or annual is an annual. Generally speaking, no, we don't. That's part of the reason why I think that the actual implied volatility metric can sometimes be somewhat flawed as far as the way people understand it. It doesn't always work out in a way that people are able to match the implied volatility and their expectations of how they trade and make them match together. Oftentimes we get implied volatility, which is an annual number, but our trading decisions get made on a much more regular basis than an annual basis. And so this is a way for us to take it and break it down into something more relevant to how we trade. So let's talk about annual variance and implied volatility. This is really the starting point for how we're going to take this formula and use it to break down implied vol into standard deviations. Annual variance is the starting point. If you take an implied vol and you multiply it by a stock price, you're going to get the expectation for total movement over the course of an entire year. So if you have an implied vol of a straddle, let's say that's 20%, and the stock price is around $100, your annual variance is what I just showed you. Annual vol, implied vol times stock price is equal to annual total variance. So in this case, you would have annual variance is equal to $20 on this $100 stock for the entire year. Does that tell you a lot about how much this thing might move over the course of the next month or weeks or days? The answer to that is not really. What we use in this case is annual variance and then break it more manageable pieces. So we're going to take that big block of variance from the numerator and we're going to break it down into smaller pieces. Breaking down the annual variance, you need to use the denominator. Now, we can break this full annual variance number, the big block of variance, down into lots of different periods of volatility. Slicing this into more localized expectations of movement, we're going to be able to look at it in different ways. One of them is the daily standard dev, which is what I talk about an awful lot. That's using the square root of trading days in an entire year. And what you're really doing here is you're taking that big block of variance, the annual variance, and you're slicing it into 252 equal pieces. That tells you that you can take the annual variance and say, okay, based on this information, based on what I have in front of me, the expectation for movement over the course of the year is this much. But if I slice that into 252 equal pieces, I can think about it as a daily expectation of movement on any normal trading day during the year. That's daily standard devs. In this case, you would use the square root of 252, like we just talked about. But you don't just have to do daily standard devs. Sometimes people want to look at it as to how much can I expect this thing to move on a weekly basis. Let's say you only want to look at your portfolio every week, and you want to know whether or not this stock that you have options in, or just maybe you don't even have an options position in it. Maybe you just want to know what the options are actually forecasting for movement that you can expect out of this stock over the next week. Well, in this case, you would use the square root of how many weeks are in a year? 52. You would use the square root of 52, an estimate of how much you might expect something to move on any given normal week during the year. Oftentimes, people also want to look at monthly standard deviations. How much can I expect this thing to move every month? If you only want to look at something once a month and you want to know whether or not the movement that you're seeing for that month is inside or outside of the expectations of movement based on the option prices, you can use the square root of 12 because there's 12 months in a year as the actual denominator of this equation. But the whole point of this is essentially you're taking that big block of variance, which is the numerator, and then you're slicing it into smaller pieces that you can use more locally as far as your understanding of how much something might move going forward. Now, all of these assumptions are based on current implied volatility levels, and as you know, if you've been watching option prices, you know that implied volatility and option prices move. You're also, guess what, seeing implied volatility move as well. So when we are talking about breaking this down, because variance is actually, the definition of variance is the expected value of the squared deviation from the mean. So what you have here when you're creating full annual variance is expected value of squared deviations from the center, from the mean. As far as a probabilistic approach to this, we need to, if we're going to take that for the entire year and break it down into a price that we expect something to move, we have to remove that squared nature from the annual variance calc. How do you do that? You actually divide by the square root in the denominator of the equation. And so that's why we use the square root of time on the bottom of the equation, on the denominator of the equation. So the square root, the standard deviation is the square root of the variance. And this is why, like I said, we use the actual square root of time in the denominator. We have to take that big block of variance, and then we have to remove the variance from it in order to get a price, a total number of dollars and cents that we expect this thing to move on any normal day during a full year of trading. So let's convert some of these to daily standard deviations. Let's think about this in terms of a way that we might actually see it play out in front of us. So to slice this annual variation, to slice the annual variance into standard deviations, we're going to take the square root of trading days as the denominator. Again, 252 trading days in an average year. Square root of 252 is 15.87. For simplicity, we're going to use 16 as the denominator. So what does this look like in practice? We're going to go back to that original assumption. $100 stock, 20% implied vol, and it's a 30-day option. Let's look at how much movement this implied volatility level, this 20% implied vol, is forecasting for any average trading day during that 30-day duration. Remember, these options are 30-day options. So when you're looking at this, what three pieces of information do you need? You need implied volatility, we have that. You need stock price, we have that. And you need to know what you're going to use in the denominator to actually slice the annual variance down into pieces. We also have that. We're going to use 16. So daily standard dev equals implied vol times stock price divided by the square root of trading days. So in this case, our daily standard deviation is going to be 0.20. When you see these implied vol numbers, a 20% implied vol, for purposes of vol math, gets converted into a decimal as 0.20. So in this case, 0.20 is your implied vol times 100, which is your price of the underlying stock, $100 stock, and divide it by the square. What we end up with is, remember, this annual variance is that $20 of movement that you would expect for a whole year, and we're going to subset it into 16 individual pieces, which equals 1.25. That is our daily standard deviation of actual dollars and cents movement per any normal trading day. What this does is it gives you an expectation based on the implied vol level and based on the stock price of how much you might expect this stock to move going forward on any normal day. So our daily standard dev in this case is $1.25 per day. Once you've got that figured out, $1.25, this means that this $100 stock with a 20 vol is implying an average daily move of $1.25. Now, this does not denote direction. It doesn't give you it's moving $1.25 up or down. It really talks about just how far away from the mean we are talking about movement for this underlying stock. It does not denote direction. It just gives you gross movement away from the mean. Oftentimes people will use this, and the way that I used this, to be brutally honest, when I was trading actively, is that I would spend a lot of time looking at implied volatility numbers and building into what I called tattooing on my brain an expectation of how much this thing might move. I used to trade in London. I used to trade the Bund, the Bobble, and the Schatz, which are the 10-year, the 5-year, and the 2-year German bonds. The Bobble, the Bund, and the Schatz would all have different implied volatility levels. They would also have different historical vols for the underlyings. If you think about it, in the same way that we look at the rates in the United States, the futures on the rates move completely differently depending on the duration of the bond that you're trading. And so the actual underlyings that I was trading against each other would have different characteristics of movement. If something moved in the front of the curve, I would expect it to have a different character of movement up front than I would in the back of the curve as far as duration is concerned. Well, guess what? Those options were priced completely differently as well. The reason why is because I wasn't the only person that had these expectations of movement. Everyone else did as well that was trading the options. And so what you get is a totally different expectation of movement in one part of the curve from another part of the curve. And that oftentimes shows up in how the options are priced. So while I might see a daily standard deviation of 30 ticks in the bottom, in the back of the curve, something that moves around an awful lot, I might see a daily standard deviation of like 1.5 ticks in the front of the curve, or even less in the shot. This gives you a better way to build an expectation, a framework of expectation of movement for what you are trading. And it all comes from the actual price of the underlying and the price or implied volatility of the options. Again, this does not denote direction. It just gives you an idea of how much something might move away from the mean. Let's talk about real world applications here. I just gave you a little bit of a real world application as to how I used to use this when I was trading something that was relatively complex. But let's talk about something where you're just trading one stock and you have options on it. What I like to think about this as, it's a way to contextualize your underlying movement when it happens. It's a way for you to evaluate whether what you're seeing in front of you is within the boundaries of the way that the options are priced or outside of the boundaries of expectations for the way that the options are priced. Let's look at that previous example again. $100 stock, 20% implied vol, and 30-day options. Again, we solved for this already. $1.25 of implied daily standard deviation of movement. That 20% implied vol is telling you right now that the options are priced in a way that most people who are pricing it are thinking this thing is going to move $1.25 per day as a forecast for this 30-day period. Now, any random day you walk in and the stock is up $7. Positive corporate news or some buyout, some sort of whatever is going on. Stock's now trading $107. What do we think of when we see this as far as the move is concerned? Well, most people are going to look at this and say a $7 move is a big move. It's a 7% move. That's a big move on one day, obviously. It's a large move by any account. But in terms of raw movement happening on one individual day, $7 when you're using the actual framework that the options have given you as to how they were priced previously, tells you that this is a 5.6 standard deviation movement. It's more than a 5.5 SD move in one day. And usually in this case, if it happens pretty quickly. You just saw a 5.6 standard deviation move. What does this tell you about the options going forward? Or how does this change the way that you think about options? Is it something you expect to continue to happen? Is it something that you would expect is going to translate into more movement in the underlying? Or is this a one-time thing? Does this change the way that you think about the options? In this situation, I like to talk about it also in terms of if you walked into this situation and you were long options, does it change your opinion about your position? Does it color how you think about the options going forward? If you were long options, chances are you probably made money on this move. What about if you were short options? Does it change how you think about the option position that you have on, whether you're long or short them, or your expectation of how much this thing might move going forward? Let's think about it in terms of not just this static, it was priced on a 20 vol and the thing moved 5.6 standard deviations. Now let's throw another wrinkle into this. Let's suppose that during this move, the implied vol of the options increases to 40, it doubles. Now, that may seem egregious or aggressive to some people, but I can tell you, I've traded single stock options and I have seen this very situation transpire, especially in situations where people don't know how to price what is happening in front of them. When things happen and like markets kind of break in a way that is unexplainable to people, generally speaking, what happens is you get this vacuum of movement that can occupy both upside vacuum in the implied volatility and downside vacuum in implied volatility levels. It would not be uncommon in situations where all kinds of things are happening for implied vol to move up or down by this amount. So now what we have is a 40 vol in our options pricing. It's a $107 stock and it's a 40 vol. And now we have 29 left in our options. What does that mean for the implied volatility and the implied daily standard dev that we're getting from it? Well, if you use the same formula, the rule of 16 that we just used, you can look at this and say, okay, the 40 vol times the $107 stock actually gives me 2.67 of implied standard deviation on this going forward. We still have 29 days left in these options. The question then becomes, is this reflective of your expectations for daily standard deviations going forward? These options that you're seeing right in front of you are completely different and priced in a completely different way than the options were priced one day previous. One day previous, these options were priced on a 20 vol, and the expectation for movement was $1.25 of movement in the underlying per day. Now what we have is a 40 vol and $107 stock, which implies $2.67 of actual underlying movement per day. Does that match the way that you are thinking about these options going forward? On the previous slide, I said, if you're long options and you walk in, does this change how you feel about the options position? Or if you're short options and you walk into this, does this change how you feel about the options position? This is why I think that this tool can be really useful for people when they're looking at this standardized way to think about it and what the actual implied volatilities are telegraphing to you about what the market is thinking going forward. Now, I always include into this conversation the idea that this is not a guarantee of movement. When we're talking about options pricing, we're talking about a crowdsourced idea of value. That's what bids and offers create in this NBBO marketplace. And when you get into a situation where options are priced this way, what you're getting is people coming in and saying, I do expect this to move in this way. And those are the people that are generally buying the options. And then there are people who are saying, I do not expect it to move in this way. And those are the people that are generally selling these options. But the meeting of those two minds and those two differing opinions is what creates the marketplace. It's important from the sidelines to be able to look at these metrics and understand what they mean as far as implied daily movement going forward. That's why I think the rule of 16 is important and can be utilized in that way. It gives you a framework to think about what that actually means. Oftentimes, people ask me a lot of questions about implied volatility because it's not a very intuitively easy to understand concept. A lot of times people say these are 30-day options, but the vol that I'm getting, the implied volatility that's associated trading is an actual year-long estimation of volatility. Like, I don't understand how that works. And so what I think of when I think of this is a great way to take implied vol. Anytime you look at it as an annual number, to be able to take that annual number and break it down into something that's more relevant to the time frame that you're actually trading. Oftentimes people will carry 30-day options or 60-day options or 90-day options. If you're trading an option that has 30 days in it, a 252-day implied volatility doesn't give you a lot of actual relevant information about the 30 days that you're theoretically holding that option. So let's break it down into more manageable and relevant pieces of information. So with that said, let's solve for the standard deviation. I'm going to give you 3 different setups. And I put the formula at the top to remind you all you need in this situation to get to the daily standard dev is implied volatility level, stock price, and a denominator of some sort that you want to use. In this case, if we're looking for daily standard devs, we're going to use the square root of trading days, which is square root of 252 or 15.814, or in this case, 16. Let's look at 3 different setups. Example 1, $256 stock. Implied vol is 38%. Remember, when we're doing vol math, we are converting this 38% into 0.38. We're going to multiply that vol times the stock price and divide by 16. So in this case, 0.38 times 256, which is the stock price, divided by 16 gives you your daily standard deviation. In this case, $6.08. What these options are telling you on a 38 vol with the $256 stock is that they're priced in a way that is telling you that fair value currently is $6, around just north of $6 of movement in the underlying going forward. That's what their expectation is. It's not a guarantee. It's just an expectation of how much this thing might move over the next 30 days or however long the duration of this option is. Example 2, different stock price, $35 stock. Vol is 76 on these options. Again, when you're doing vol math, you convert that implied vol to a decimal, 0.76 times the stock price of $35. Again, we're going to divide by the square root of 252 trading days, which is 15.814 or 16. And in this case, your daily standard deviation expectation is 1.66 going forward. In this case, that $35 stock with a 76 implied vol is telling you that the market expects just north of $1.60 of underlying movement for this $35 stock. All right, third example, sorry. Stock price is $84 and the implied vol is 110 on these options. If you're converting things for vol math and the number is lower than 100, it's going to convert to in this case, 0.76. If it's above 100, if the vol that you're looking at is 100 or if it's 200, you're going to convert it to the same decimal, but it's going to be 1.10. It's north of 100 as far as the vol is concerned. So in this case, 1.10 times 84, the stock price, divided by 16, remember, square root of 252, or 15.814, rounded to 16, gives you a standard deviation of $5.78 of underlying movement. $84 stock on 110 vol is going to give you a standard dev of 5.78. Many times people will look at this and look at this page full of numbers and say, okay, like, that's great. How do I actually use this if I'm looking at something like the VIX or something that's not like a individual stock? I want you to think about what the VIX actually is. The VIX is essentially a non-tradable index. You can't actually trade the underlying VIX. The VIX is merely a measure of the 30-day implied vol of the S&P options. They take essentially in some kind of like mixed way the 30-day implied volatility in the SPX, and they pull out of it what they view, what the SIBO views through a mathematical calculation. They don't just use the at-the-money options. There are other options that are involved in it, but the idea behind this possible expectations for movement are through the implied volatility of the S&P 500. So in the case when you're looking at the VIX and it's trading 20, what that's telling you is that it expects 1.25% move in the S&P per day right now for the next 30 days, because that's a measure of the 30-day implied vol of the S&P 500 options. Now, those vols move around constantly. Like I said, implied vol and price are linked. And if prices are moving, generally speaking, implied vols are moving. Does that make this any less relevant if it moves around? The answer is no, it doesn't. It actually makes it better to be able to look at what potentially it meant yesterday for implied volatility and theoretical expectations of movement, and what it might mean today as things are priced differently. What does that mean as far as what people's expectations of movement in the marketplace has changed over the last 24 hours? And if you start to look at it in a really granular way and look at it on a daily basis and think about how much those options are moving in terms of price and volatility and expectation for movement, it can give you a really nuanced idea of what people are expecting for movement in the broader index, if you're using it on something like the S&P, like on the VIX, or in these individual stocks, where implied volatility is priced on a more specific basis because there might be events that are built into a specific stock's horizon that are not necessarily built into the index. And so oftentimes when people are looking at specific stock vols, implied vols on a monthly basis or on a weekly basis, they'll see that it doesn't always have any like natural curvature to it, that there are some big like hiccups in where the implied vols are priced. That can happen in terms of if you think about how much you would expect something to move, and all of a sudden there's earnings built into 1 month of options where the earnings are not built into the next month of options, you would expect if that stock has moved a bunch on earnings in the past, that the implied vols of that month that include the earnings are going to be much higher. Guess what? It's an expectation of movement for that period of time. And what the market is telling you is we expect more movement in here than we do in here. And so you can start to look at it in kind of blocked ways that give you a better idea of where people are expecting movement, what duration they expect it from, and what kind of movement, like how vast they are expecting the movement to be during that period of time. So that is basically the rule of 16 in a nutshell. I always want to bring up, again, optionseducation.org, which is where we host all of our educational resources, and options at theocc.com to get in touch with us with questions that you have going forward. And I would like to see if we have a little bit of time for some questions. Andrew, what do you think?
Yeah, certainly. Does this formula work for weekly options as well? Asks Bill.
Yeah, it does. Certainly it does. This will work for essentially anything that you're looking at that is an implied volatility. It's an annual vol. The one thing that I want people to really build into the expectation here is that if you're looking at it for a weekly option, you really only have 5 days of delivered volatility that it can actually play out in this way. So when you're looking at it and you're looking at 5 days of implied vol, that is really what you're looking at. The market is telling you that this is an annualized vol, but we're going to set it at this level for the next 5 days of expectations of movement. Keep in mind, you're going to have a much smoother kind of idea of whether or not something's going to play out over the course of something like 30 days or 60 days or 90 days than you are if you only have 5 days of price iterations that are going to actually, be able to tell you whether or not the thing moved or not. So just like anything, just like if you flip a coin 1,000 times, the distribution of heads and tails is going to get much closer to 50-50 over time. If you flip it 4 times, there's a much greater chance that you might get 4 heads or 4 tails than if you flipped it 1,000 times. The same holds true here, but you can use the same math. I just want you to think about whether or not it gives you the same amount of information for 4 or 5 price iterations as it does for 30 or 60 or 90 price iterations. That would be my advice there.
Very specific example here asks about mergers. If a definite merger has been announced, let's say it's a cash deal, its announced price typically does not move.
Andrew, I think I lost your audio.
Okay.
Or maybe the mics.
Can you hear me now?
There you go. There you are.
Okay. How do you use the implied volatility number once a definite merger has been announced? Say it's a cash deal, the merger is announced and the price typically does not move other than for merger-related matters. Any thoughts on that?
Yeah, I definitely have thoughts on that. The thing that you need to keep in mind when you're looking at this is that generally speaking, when you're looking at option prices, those kinds of expectations are going to theoretically be built into the option prices going forward. And so what you might see, I'm not going to say you're always going to see this, but what you might see is the buildup into some sort of corporate event like that, like a merger, where there is a bunch of uncertainty as to how it's going to play out. Those implied volatilities might be higher and higher and higher as we get closer to the event. Just like in any corporate event, what you have is uncertainty before and more certainty after those events. Generally speaking, I refer to those as what I call vol-reducing events. Now, do they always reduce vol? No, they don't always reduce vol. But what you're going to see most of the time is that the implied volatility is going to factor in the fact that we have more certainty now than we did 2 weeks ago, right? As far as if the event happened yesterday and we now have a disclosure and all kinds of SEC stuff going on where people are actually talking about how this is going to go forward, we have more certainty now. In those situations, generally speaking, you're going to see the implied vols move in a way that the market is digesting that amount of information, that amount of certainty that exists now previous to where it was uncertain. And you might see the implied vols come down in that scenario. You can do the same math here and think about it in terms of, okay, previous to this, I did not have any certainty as to how this was going to play out, and the vol was priced at a 40. And in the situation that I showed you in this case, right, that showed you a $100 stock on a 40 vol gives you $2.67 worth of expected movement on any daily basis. Well, think about it in the opposite way. Instead of the vols going up to 40, let's say something came out and we have more certainty, and now the vols are 20. In that case, you went from the expectation of $2.67 worth of movement on a day when we had no certainty as to how this is playing out, to all of a sudden after you have vols at a 20 now, where you're expecting $1.25 worth of movement. If the stock, let's say, went from 107 down to 100, you're thinking about 1.25 of movement going forward. This allows you to be able to look at that and say, is that what I expect going forward? Instead of just like, many times people will look at that and say, well, the vols used to be 40 and now they're 20. And a lot of times people will be like, well, I have to, if I bought them when they were 40, I have to buy them when they're 20. I don't necessarily think that's how you should be doing the evaluation of the math. The way that you should be thinking about it is the vols used to be 40, now they're 20. What is this saying about the expected movement going forward right now, based on the amount of information we have right now? Because that gives you a different picture rather than just, well, the vols got cut in half from 2 weeks ago to now. What it really does is it colors how you expect things to go going forward as far as the market pricing is concerned, and then evaluate whether or not the way you think about it lines up with how it's priced. So that's my take on that situation.
Matt, what model did you use to compute the standard deviation? Asks Michael.
What was the question again? Sorry, your audio is a little wonky.
What model did you use to compute the standard deviation?
What model?
Mm.
Yeah. So all of this is done using Black-Scholes. So implied volatilities, when we're when we're looking at them, are done using Black-Scholes as far as the implied volatility is concerned. Generally speaking, I use that just because it is the most widely used kind of model and the way that people think about implied vol across the industry. There are different implementations that people use different models, and they can give you slightly different ideas about how much something might move based on those numbers. But broadly across the industry, Black-Scholes is what most people use when they're talking about implied vol.
Very good. Matt Cashman of the OCC, thank you very much indeed.
Thank you for having me. I'm glad to be here. Send us emails if you have questions at options@theocc.com.
All right. Cheers, mate. See you soon.
Cheers.